founder and CEO of Integgra. Thank you, perfect. Really excited about this workshop. We're going to be going in more depth about valuations and instead of stock options. Really excited. But before we get started, just want to give everyone a heads up that we have a monthly meeting coming up next week. Really excited. It's going to be on the rooftop on the 7th floor at our brand new location at the AC Hotel. If you have any questions about the monthly meeting, please contact me at sebastian@tieatlanta.org. It's going to be a great event. We have Kabir Barde, the founder and CEO of OneTrust. OneTrust was the fastest growing company in 2020. And we also have a great panel that's going to go into more depth about product market fit and business development. So I'm going to switch it to Gregg's PowerPoint and I'm going to let him come up now.
Okay. They've asked me to do this with EarPod, which I've never done before. So let's see how this works. I feel like Shrek a little bit. Well, great. Thanks for being here tonight. Thanks to TiE, me and Sebastian and everyone for coordinating this great event. I know we have a great turnout online as well. I see lots of friendly, familiar faces in the room. So welcome. Try to entertain you tonight with some valuation humor. That's a stretch. Not much valuation humor out there, but we'll do what we can to make it interesting and educational. So, as Sebastian said, I'm Gregg, and I've been doing valuations for about 20 years now. So everybody says sort of, how did you become a valuation consultant? And by the way, I prefer valuation consultant to appraiser. I was joking with Juan. I said valuation consultant sounds complex and sexy, and I can charge a lot of money. But as a business appraiser sounds just like a home appraiser. So, and they don't make as much. So I'm going with valuation consultant. So I've been valuation consultant really ramped up in the early 2000s after the first .com bubble burst. And what happened at that time was it was the first time that it was cool to work for a startup, and people got stock options, more than ever before. And so myself included, I left a couple big Fortune 500 companies, namely Freddie Mac and MCI, which became WorldCom, both well known for having huge accounting frauds. And so this was educational in its own way about sort of the integrity, importance of integrity in business. That's the name, Integgra. So left to get into a .com that was a subsidiary of IXL, which many of you probably remember. Bert Ellis ran IXL, internet consulting company. A little .com therein, and I got 50,000 options, and thought I would be rich one day, but still, today, it's a big problem that nobody, when they get their options, understands what they're worth. I mean, are they in the money? Are they out of the, how much potential do I have? What's this company worth? How much are the options worth relative to the current value of the company? Some clients even hire me to periodically speak to their employees to give them a little education. I think it's a great idea, but very few really teach their employees what they're getting as part of their compensation package. So mine turned out to be worthless because back at that time, companies could actually set their own option prices, which is a scary proposition if you think about it. But it was the Wild West in the technology and .com world. So either companies, very few really know how to do that properly, and so they either made mistakes by areas of omission or commission. Sometimes they would manipulate, and a lot of companies got in big trouble. CEOs fined, went to jail, etc., for mispricing their options. And the IRS, as it goes, doesn't really care if you, as a company, overprice your options and nobody makes any money, but they do care if you create cheap options and everybody sort of enriches themselves unjustly. So still today, when after that period, the Sarbanes-Oxley regulations came out in the early 2000s, and part of that for compliance was what the IRS calls 409A. That's their code for the annual option pricing exercise. And that sort of was the Valuation Employment Act, because now every company issuing options had to get a valuation annually to continue issuing options every year. So it created some guardrails. I mean, you ask every different valuation consultant what was the value of a company, they're going to come up with some slightly different answers, hopefully just slightly. But so there's a range of reasonable, but at least it prevents companies from falling off the rails and creating a cheap stock violation, which the IRS can penalize them for. So around that time, I got recruited to join my first valuation firm because all of a sudden all these had to get done. And so I learned the business at a couple different firms, and worked my way up to my third firm was Silicon Valley Bank, which many of you know. It's a great bank, serving the tech community. And when everybody was asking where to get these done in the early 2000s, they came up with the idea that they would try to create a group and do it themselves. It created a lot of stickiness for the bank, but they could really never figure out how to make money doing it. But they were the first company to really try to scale business valuations and 409As and perform them in the thousands. Because generally it's been a mom and pop kind of thing, 1 to 10 employee kind of shops. So it was a big experiment. And sort of the main learning out of that is it's very hard. Nobody's really figured out how to do them profitably at scale. So they eventually, the writing was on the wall, and they could never make money doing it. While they had thousands of them to do, the pricing with all of their overhead of a big organization like that made it impossible to make money doing them for the price that the market will bear for mostly unprofitable startups. A few $1,000s roughly, depending on the stage of the company. So eventually it became clear they were going to fail or launch that group, which they did, to a company that thought they could automate the process, and ultimately that failed as well. So that company, who will remain nameless but still is out there, is doing thousands of 409As very poorly after killing their software product and hiring lots of people from the Pac-12 with history degrees from Arizona State or wherever they come from to do them very poorly. So they're stuck with SVB's problem now of having too much overhead and doing them unprofitably. So I came up with the idea that I could have my life back and not do thousands of 409As every year, hundreds, charge less, and make money and still deliver as the same or better quality as SVB was. And it turned out to be super successful for 12 years now. So more than anybody else around, excuse me, Georgia, or probably the South, I do technology, like early stage evaluations. And my friendly competitors either don't want to do them or don't do them or don't know how to do them, actually, because there's an art to in nuances to earlier stage valuations, and you can't use traditional valuation methods. So we'll get into why that is and so on, but that's kind of my background and how I end up doing what I do. So I'm going to give you first a little update. I guess the question right now is kind of, which way are we going? We had a huge bull run for several years, and then the last couple of years, COVID and the current administration kind of caused us some challenges. So 22 was pretty rough, but we're sort of in a transition period. So the good news is we got some data hot off the market. There's always a bit of a lag with data, which is part of the challenge of valuing startups, because public companies are traded real time. You can get current data, but it's always months, some number of months. Used to be 9, 6, and it's been getting less and less until we get some substantial valuation data from big companies like PitchBook and Capital IQ and so on. So the fourth quarter data just came out from PitchBook, and Sebastian, I'm not moving forward here. Let's see what's happening. Thank you. So as I said, we've been facing a lot of headwinds: inflation, supply chain issues, labor shortages, energy prices, policy risks, global conflicts, and really high valuations that have kept on going through COVID, which really didn't make sense. You know, you have companies more challenged to raise money, not performing as well, but their valuations were still high, and it didn't make sense for elite angel investors, especially, to continue to play the game. Now, there's a big difference between motivation of an angel investor, individuals that go to TiE Angels and Atlanta Tech Angels and so on, and professional firms, venture VC firms, PE firms who are required to deploy capital. So a big source of overvaluation has been their need to chase deals that might not have been so great a few years ago, but despite the economy, they still had a lot of cash or dry powder sitting around that they had to spend. And so it created competition for fewer and fewer good deals. And it was a real reason why mid to later stage deals for a while were overpriced relative to earlier stage deals, when angel investors like ourselves we're not required to write a check. So if it wasn't a good deal, maybe we weren't writing checks as often as we had been. But capital supply was still there. And but to some extent, a lot of these risks that we're looking at have mitigated, you know, in the past 6 months. Things are improved, so you would expect maybe things have started to turn around. So it was interesting to see what the data suggests. And Sebastian, we're not clicking again. Yeah. So here's an interesting chart comparing, on the public side, what's been going on the past year or so. We bottomed out around October, and since then things have ticked up incrementally. As I said, the S&P is up about 4% year to date, and the Nasdaq's up about 10%. So not necessarily directly correlated to the private markets, but it's a start. And this is a super interesting chart, and it only goes through May, and I haven't been able to get an update since then. But everybody talks about revenue multiples, okay? So relative to EBITDA multiples. And by definition, I have to say, first and foremost, that the value of a company is considered to be the present value of its future cash flows, not its revenue, but its cash flows, or EBITDA. So everybody being hung up on revenue multiples needs to think carefully about how meaningful they are relative to the value of a company. And I want to pause now and talk about a quick example of a valuation I just did, where I'm going to make some numbers up, round numbers. This particular company, it was in the digital marketing space, which is super hot and interesting. Let's say they had 10 million in revenue, and there was a partnership dissolution. There was a 2/3 owner and a 1/3 owner, and the 1/3 owner wanted to be bought out. So this person goes to the CEO and says, "I'm leaving, buy me out." Well, okay, what's your number? Well, I hear, and my advisors say, that digital marketing companies should trade about 3x revenue. So we should be worth about 30 million. Therefore, my 1/3 is about 10 million. Write me a check. Oh, nice, right? No. So this is when you get into, you know, considering the how meaningful revenue multiples are. When we got into the cash flows and all of the adjustments that had to be made for all of their various expenses and non-standard things that they do to make it a nice place to work, and big trips and so on, cars, it's a very low margin business. So when you got down to the cash flow, the $10 million percentage-wise came down to about $1 million for the third. The company turned out to be worth about $3 million, or I mean, well, whatever. Third, yeah, about $3 million, and the third was worth about $1 million. So that's buyer beware when it comes time to think about multiple. Correct. So there's strategic value versus fair market value, and their operating agreement committed them to a fair market value valuation. And that was one point the other side tried to argue, like, I could go out and sell this to somebody else for more. And like, go ahead. See if somebody's going to buy your minority share, and you'll have no voting rights or no control. And it was basically unmarketable. So anyway, multiple software multiples that were so hot, especially in fintech, the blue took the biggest hit in 22, and at one point we're down about 80%. And that the old 10x multiple became 25x or 15x for some sectors for a short period of time, but now with under surrounding 5x, which is much more historically normal. But this is where we are and where we came from in the last year and a half. Sebastian. Yeah.
I think it's whenever takes over the screen.
Yeah. Okay. Yeah, probably for a fee. Yeah. So more info on kind of where we are. Just regardless of which direction valuations or the volume of deal flow in 22 is way down. So still, there was money chasing better quality deals overall, but harder for the lower quality. But oddly, what the data shows anyway is that unlike earlier in the bull run, the early stage held up better than the late stage. The reason apparently was that there were fewer exit opportunities, and late stage companies got stuck not being able to exit, and they really weren't able to continue performing as well. And so their valuations, there was a lot of down rounds in the later stage. The data shows that the early stage held up pretty well from year to year. However, that data tends to be very biased because, as it turns out, companies don't like to report down rounds. So there's a strong bias to companies only reporting positive outcomes. So there we go. Then we get into sector considerations. B2B valuations typically almost always outperform B2C valuations, and that continued to hold up. You see the sharper drop in the B2C sector, at least at the later stages, especially, as I mentioned, but kind of an eye chart. And if you look closely, you see that the B2B valuations always are a bit higher than the B2C valuations. So quick reminder about valuation terms, the different options you have in raising money. Safe notes have become more popular, more common in the South, I suppose, but still mostly out of favor compared to the standard convertible notes and preferred equity rounds. Safes have always been more common out west, but they do not carry any interest rate, no maturity date. They may or may not have a valuation cap or a discount on the valuation included. You do have to be a C Corp, and they may convert to common equity later. convertible notes are a little more secure for the investors. They do have an interest rate, so they are considered debt. There's a set maturity and a cap and a discount. And then there's the standard preferred equity funding round with the liquidation preferences, which means you get paid first over the other classes of shares after the debt, of course. And you may have the right to participate or sort of double dip with common stock upon conversion. So now, as we were talking about earlier, how do you do evaluation? So the answer is it depends on your stage generally. And if starting from the right side, if you have positive cash flow, you prefer to do a typical business school discounted cash flow analysis, which we call an income approach, to determine the present value of your forecasted cash flow. So of course, it relies heavily on the forecast and how reasonable it is. So part of my job is to assess that reasonableness and assign an appropriate discount rate or cost of capital to that forecast. Otherwise, without that assessment, a hockey stick forecast may lead to an unreasonably high valuation. So, and you can combine that ideally with, or sort of triangulate the result of that with a market approach using public companies in their EBITDA multiples, and or private M&A transaction multiple, EBITDA multiple. So it's a good sanity check. Am I going to bounce again? To have more than one answer, and ideally they should line up with each other within about 10 or 15%. Otherwise, you're going to need to relook at the outlier and try to think about why it's not aligning. And if you do that, generally, as a good valuation consultant, you'll be able to understand how things should align. So that gives you more confidence in the outcome because you've got more options, more methods to include. Without cash flow, though, you have to revert for earlier stage companies or unprofitable companies to only revenue multiples, which doesn't give you a lot of confidence for the reasons we talked about before. So you have to be very savvy in terms of selecting the multiple to apply to the company's revenue and perhaps even its forecast if you want to include forward multiples in the equation. But the big thing that even some experienced valuation professionals miss, if they're not experienced with earlier stage companies, is the very, very strong correlation between smaller companies and lower multiples. So what we always do when we have a nice set of comps is list them by size, and almost always you'll see the correlation fall out with the smaller comps having lower multiples. So that pushes you to select typically a lower multiple to apply to your much smaller private company than public companies, and maybe even something below the low end of the range of a public company. Because just blindly taking the mean or the median of the group is typically going to cause you to overvalue the company you're assessing. It's really important.
Explain how you go about selecting a discount rate for cash.
So there's a couple methods. The question is how do we assess the discount rate and determine the discount rate to apply to the forecast in the DCF analysis? And there's two primary methods. The first, if you have a more mature company, you can use what's called the CAPM, capital asset pricing model build-out method. And there's a number of components to it, and you typically come up with something in the less than 20% range. But for most of the companies I'm working with, the earlier stage companies, above that becomes very subjective. And so it's hard to differentiate or argue for 22 versus 26 versus 33. And so the AICPA, American Institute for CPAs, has a venture capital cost of capital chart with ranges for different stages of companies. So from startup to growth stage, basically, to expansion, and then sort of, they call it bridge or IPO as you're approaching an exit. And so it just gives you a broader range. Maybe at the later stage, it'll go from 20 to 25 or 25 to 35 for the next stage and beyond. So it gives you a pretty good idea of, depending on where obviously the company you're assessing falls into one of those ranges, the appropriate cost of capital to suggest. At the highest range, for like a life science startup with a long exit, 7-10 years or more, FDA approvals require all of that, something in pre-revenue, you could go 50 to 70%. But for a series, B company that's got a 10, 20 million profitable, you're probably looking in the 20-25% range usually. So I hope that helps. So back to the chart, I guess that ultimately, when revenue multiples, there comes a point where they don't even make sense. So you have a pre-revenue company or a company with just a couple 100,000 in revenue, applying a revenue multiple of 3, 4, 5x, even 10x in that mythological world to a $100,000 company gives you a value of $1 million. That's probably not right, if you got 50,000, so you need something else. And this is where you really need some experience, valuing early stage companies and having your finger on the pulse of what they should be valued at. And a lot of that comes from experience of just attending, hundreds of pitches over the years through TiE Angels and ATA and other organizations, and knowing, at least in this market, what investors are willing to do. So generally speaking, around here, Paul could testify, if you go over 5 million and you're at that stage, you're probably not going to raise money. It just doesn't almost matter what you do. Investors will tune out if you go 8, 10, 15 million, like la, thanks, next. So that's step one. And that's really why it's important for a lot of companies coming into these Shark Tank situations that aren't experienced pitching, why they should have a conversation with me at least to get a sanity check on their number in their pitch deck before they go into that room. Because if they go into that room too high, we've all seen Mr. Wonderful just, chuckle and laugh people out of the room in the Shark. And we're a little nicer in our meetings, but the result tends to be the same. So, but still there's a big difference between, $1 million valuation and a $5 million valuation. Where should a company be in that range? So many will come to me and ask for that. And something I think I do that nobody else I know does is to make myself available to those people to help them solve that problem at a very nominal fee, and to make sure they don't shoot themselves in the foot at that point before they go into the tank. So we'll do, it's called the scorecard method, and I didn't make it up. There's a famous fellow whose name escapes me, might be Bill, I was going to say Bill White, but that's the Buckhead City guy. Bill Payne, I think, is his name. And he wrote a white paper about how he believes this should work. And I sort of did take it to the next step and translate it into a worksheet that I do with online, and we do a screen share, and we assess the company together, and the CEO or whoever CFO gets input into it and understand the calculation through it, and gets an answer at the end through this worksheet. And so what it includes is several adjustments that are necessary just as a baseline. What we have to think about is just not for starters, a median national angel stage number, which we'll see just came out in PitchBook was 4.9 million last year. But in and of itself, that's a useless number because it doesn't consider the adjustments that have to be made for the region that you're pitching in. In the South, we tend to be less than the median thanks to the bigger tech hub. The size, so a pre-revenue doesn't get the same as a $500,000 revenue angel stage company. The sector, is it B2B, B2C, FinTech, Health Tech? And then a year-to-date adjustment, because the data we have is only as good as probably the last quarter, and things change. So you have to look at that. After all that's considered, we come up with a number that we use as a baseline. And then we do a company-specific assessment, the scorecard. And that will result in a factor of greater or less than one being par. That could be 0.75 or 1.25. So now we're going to do a little example. Here we have an angel stage, Southeast, free revenue, B2B, SaaS, healthcare, IT company with a first-time CEO. As of today, we're going to value this company. So is it going to be, a high five for Mark Cuban or a head shaker? So in this company, in this case, we start with that 4.9 million that just came out. We give a 20% haircut to the South. We give another 10% haircut for the pre-revenue lower end of the range in angel stage. We give a 30% boost for the SaaS B2B model and a 10% boost for the market movement this year. So the net of all that, after a 20% discount for the first time CEO, which always gets the most weight is the experience of the management team, we end up with a net of a minus 10%. So we just take that off to 4.9 million and we're down to 4.4. So less than that 5 million number and keeps you in the game. So somebody like that might come in and say, oh, I'm in B2B SaaS healthcare. I should have at least a 10 million valuation. And if they do pitch that, they're probably not going to succeed. But that's a much more reasonable starting point. So if you're doing a 409A, that was just for funding. If you're doing an option pricing valuation, you're eligible for a couple discounts. So in the most simple example, if you don't have multiple share classes with preferred stock in the mix, which requires a very complex Black-Scholes option pricing calculation. Let's just say we have a straight line waterfall here. If we started with a $3.6 million value for the whole company, a controlling marketable ownership interest basis, you get discounts for a lack of control or a minority ownership interest and a lack of marketability for the illiquid period that you're holding the shares. So generally, you'll get about a 10% discount for lack of control. And depending on the stage, for a very early stage company, discounts have been more generous lately as exits extend. You might get something up to 50%, but something 35 is probably more common for a Series A and B company. So what normal math would tell you, you're about $3 a share. Before those discounts, your options might come out half or less than that, which is very helpful to the option holders. So that's kind of the nature of a 409A exercise. And with that, I will open it up to Q&A. Yeah. Mm-hmm. Okay, 20% margin. Yeah.
And
yeah.
Okay. What would be the value of the company?
Well, that's high level, but you didn't fill in some of the blanks. So are they in the Southeast?
Yeah.
Okay, Southeast. And B2B, and is it FinTech? What sector is in B2B? First time CEO. Mm-hmm. So the other categories in the scorecard are market size. Is it in a good market size? Do they have any IP? And competition. What's the competition? Mhm. Mhm. Mhm.
They do have it.
Mhm. So off the top of my head, I mean, throw it all into the blender there. It sounds like about 5 million-ish if it's in the B2B, a healthy B2B. But oh, I'm sorry. Well, with a first time founder, yeah, I mean the other one, it sounds pretty similar to the one that we had up there, you know, maybe 4 million-ish, you know, something like that. It's still pretty, either way, it's pretty small. I mean, it's yeah, you have to get. So how to consider the size of a company in the equation is interesting and depends somewhat on the region as well. So I have a fun story where right before COVID, there was a New York VC came down and to a meeting at ATDC one day. And I'm trying to be helpful and network and offer, you know, any relationship, you know, I can create. And I said, so what kind of deals do you look at? And, you know, well, we're New York seed. We're not Atlanta seed. And I said, so what does that mean? She said, well, New York seed is $1 million in ARR and Atlanta seed is $500,000. So it even depends. And then this term pre-seed came around a couple of years ago. So they're bifurcating stages a little more. And that, so the way I kind of look at it, at least in Atlanta, is I draw the line for seed around $500,000, and then pre-seed might be in the 250 range, and if there's pre-seed data available. Otherwise, I might just split the baby between angel and seed valuations to come up with a, you know, something for that size of a company. So that you get into some nuance.
Yeah, I have one more.
Sure. Their annual run rate is they go their funding of 14 million. Yeah. They go to funding for I think 17. So how that where their annual run rate is so low. Of course, they do have a market size. So bring the calculation to how that. That's not as so the question was for a Silicon Valley based company that you're aware of that had $1 million in ARR, they raised money at a 14 million pre-money valuation probably, and raised how much? A couple $1 million on top of that, maybe probably. They raised 15 million. Okay, what was the pre-money and post-money valuation? So, yeah, so this is what I'm saying. They play the game differently out west. It's gambling out there, as I like, versus investing. You know, it's just a numbers game to them. They don't give you the downside. You might get a big number out there, but you're going to have less time to succeed, and they want you to fail fast and cut their losses. So this is where all I need is 1 out of 10 companies or so to hit it big and be a 10x return, and the rest can fail, and we don't care. So yeah.
Which regions have evaluation groups that buy a Southeast?
Typically, California, New York, Austin, Texas, are the hubs. Maybe Boston, probably as well. Just traditionally, just data based. It's not. It's results based. When TiE and ATA and others report their funding rounds to these data warehouse companies, it's what falls out. You know, you just the funds, the big funds tend to be there. They have more money. They're willing to take more risk and squeeze the smaller states and fund out a deal.
Good one from Sid. How much have valuations fallen in the past 12?
So yeah, Sid asked, hi Sid, how much have valuations fallen in the last 12 months? So I guess that depends. So we covered that a little bit earlier in one of the slides, but the data that just came out from PitchBook showed that earlier stage valuations have held up, at least the ones that are being reported. If we believe that data and we don't, and we think all the down rounds are honestly reported as well, the late stage deals have really taken the biggest hit, and sector-wise, the fintech and healthcare tech have taken a bigger hit too, especially at the later stage because they were more overvalued earlier. But yeah, go ahead. Region-wise, certainly the question is, do certain regions favor certain sectors? And we've all heard that, and we're aware of that here in Atlanta with fintech for sure. I'm not aware of that kind of situation for any other particular sector outside. I'm sure somewhere healthcare gets more. I think we struggle to fund healthcare here. Boston, yeah, probably Boston and Houston, yeah. But I think California is pretty generic, agnostic with their money. Mm-hmm. 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 Mm-hmm.
Right now,
Yeah, but, mm-hmm. Right. Mm-hmm. Well, as an employee, as a founder, so I guess the question is, from with maybe if I can put it in my own words, what's a better way to look at investing from the California sort of style versus the Atlanta sort of style, and which worked out better in the end? In your first experience, you raised money at a higher number that you, like most, can't live up to. So that limits your future, and you might be out of that role in the short period of time. Right, you're right. Because the funding was so high, even though you had a successful exit by most standards, it wasn't enough for you to make a profit on the option. So that's why my advice to founders is always to try to create a win-win-win situation, which is what you need to achieve a successful exit. All the three constituents have to have roughly equal incentives: the founders, the employees, and the investors. And if any of those don't have a good incentive, they're going to drop out of the boat, and the boat will not reach the exit shore. So it's much better to raise money at a more reasonable number, give yourself a longer leash to grow the company and grow the business, and have a chance for everybody to succeed. So I think you're experiencing that now. It's a better way to go. Anybody else? Maybe not ownership wise necessarily, but incentive wise. Yeah, ownership changes with different dilution and new investments. Mm-hmm. The one point I will make in terms of ownership is that sometimes I know it's a smart, pretty attractive young company here that recently raised its first preferred round, Series A, for only, about a $3 million valuation, and they sold more than half of the company. They raised if it was worth $3 million, they sold, 4.5 post money. So they ended up raising maybe 2.5 or something like that. So not ideal, because you never want to sell more than half of your company and lose control. You might lose your job. You're not going to fire yourself. So a good guideline is never to sell more than 20% of your equity in any one particular round. So you leave room for more.
You did that evaluation, so those are stock options for employees. Right?
Mm-hmm.
So you get the CEO, no experience, let's say you're going to go rapidly and you're looking for someone to run it, maybe that's
Mm-hmm.
that kind of evaluation, you put more weight to that, trying to track that.
Absolutely. I know some, serial entrepreneurs in town that have had 3 or 4 successful fintech exits, and all they have to do is dial a phone and call somebody else that cashed out on one of the last ones, and they'll give them a $15 million pre-money valuation with no revenue. I mean, easy. It's betting on the jockey and not the horse means a lot. Yeah. I saw one other one. No, all good. Okay. Thanks.